I saw the front page of the journal today, but I don't try to pay attention to what other people think.
And then what happens? Boom, it's up through the roof. So silver, I think, is a very interesting situation. I really do think it's rather like owning gold on steroids, in a sense. What I can tell you is that it takes an awful long time to get these things through. Mining is a dirty business. And in these days of environmental considerations and all the rest of it, there are not many places in the world where you can actually open a new mine of anything. Chile, yeah, you can do it there, I suppose. Mexico, you can probably still do it, though I think things are getting rather tight there. Existing mines, fine, but new ones, yeah. And I think the other problem with silver is that, I don't know the exact percentage, but I have a figure in mind that something like 57% of mine supply is by mines whose primary product is actually another metal. So this is a byproduct. And what this means is that the emphasis in terms of capital investment and all the rest of it is really directed at other minerals rather than silver itself. On the usage side, they keep on finding new uses for it. I think one thing I would refer you to is the invention by Samsung of a new EV battery, which lasts for, it can charge very quickly. It lasts for, it's got huge mileage potential and all the rest of it, and is likely to become the standard, if you like, for the next generation of electric vehicles. And this is silver, heavy silver dependent. Lithium is not really significantly involved. I don't know the details, but we do know that this is using a lot of silver, and this is against a background of 4 years so far of supply deficit. That's according to the Silver Institute. And I can see with the disintegration, if you like, in the economic situation leading to higher gold prices, silver going up on the back of that, won't be very long before you find that institutions, serious money, will start buying the ETFs again. And that means that the source of supply, which is seen making the swing factor, but covering this loss of silver, in the sense that you've got too much supply for too little demand, too much demand for too little supply. I get it the right way around. You can see that this swing factor of drawing down on investment stockpiles is going to go the other way. And then what happens? Boom! It's up through the roof. So silver, I think, is a very interesting situation, I really do think it's rather like owning gold on steroids, in a sense. It's volatile. Don't get me wrong. When gold stops moving, just stops moving without even going anywhere, that's the point where silver tends to go lower, or has done in the past. But even then, I think the supply deficit situation is likely to catch up with it at some stage, and you could see, genuine physical shortages in, sort of beginning to really drive the price. That would not surprise me at all. No, I don't think it's that at all, John. It's really quite simple. Central banks acquire gold for monetary purposes. It is part of their reserves. And what they're doing is they're getting out of fiat currencies into real legal money. Silver does not really fulfill that function as far as central banks are concerned. If they do buy silver, it is because they might consider they're going to have to coin it at some stage. The days of gold-silver ratio of 15, 16, whatever, forget it. That's gone. It really has gone. Silver, I think, if we go back onto a gold standard, if there is a monetary role for silver, and it's if not, it will happen. If there is a monetary role for silver, it will be literally for smaller amounts of money. In the past, in this country, for example, only, I think, 40 shillings, which was £2, if you like, was legal tender. There was that limit on it. And I suspect that something like that would come into place if coinage returns. But of course, we don't know whether coinage will return in that sense, other than just tokens. I mean, basically, when a fiat currency defaults, it just loses value. It's as simple as that. As a matter of accounting, there always has to be debt on the other side of a fiat currency. So I think what is likely to happen, if the foreigners aren't going to buy debt, if the US institutions aren't going to buy the debt, then the Fed will have to buy it. So that's the way in which the government will be funded. But it'll be funded on the basis, really, of falling purchasing power for the currency, which means that even yet more currency would have to be introduced in order to cover it. And of course, when a currency starts going down, you've got to look at the interest rates. The interest rates, in order to stabilize it, just go up and up and up and up. I mean, in Russia at the moment, you've had recently a weak ruble. And what's happened, the Central Bank of Russia has had to raise interest rates, its overnight rate from 18% to 21%. Might have to raise it further. Slightly different topic, but you can see the relationship between interest rates and currencies is that the real role of an interest rate is to stabilize the currency, not manage the economy, which is the big mistake that central banks make. Well, if they cut interest rates, then they're going to weaken the dollar. It's as simple as that. So the first thing you'll see is that the yield curve goes strongly positive. In other words, the time value will come back in to longer maturities. And I think that the Fed's going to be in an impossible position. I really do. They won't cut interest rates very much. I mean, I can see that the market's discounting a cut of 0.25% or something, or 0.5%. But even if that comes in, I don't think that there will be any more cuts. I think after that, there's only one way for interest rates, and that's for them to continue to rise. If the Fed tries to muscle them down, which it probably will do, because as interest rates rise, then the credit bubble, which has been building really since the 1980s, that will burst. And when that happens, equities will crash. Property, and you've already seen the start of that in commercial real estate, that will crash for even further. Banks will be getting into difficulty. Zombie companies, of which, I mean, I don't know how much zombiness there is in the US economy, probably about 30%. They're going to be going bust. So what does the Fed do? It's got to rescue the banking system. And it probably also means that it's, in effect, rescuing the entire economy, which demands lower interest rates or massive QE.
I think what's really going on is major asset managers, hedge fund managers, mutual fund managers who've been around a while, have some experience and haven't forgotten the last 10, 20 years, gotten all gleeful because of the stock market. They're somewhat suspicious of what they see in the stock market. There's all kinds of valuations that just don't make sense. The longevity of the market doesn't make sense. The steepness, the recent steepness scares them because it's blow-off type action, and blow-offs end very badly the other way. So I think there's some smart money out there that's saying, hey, I'm not going to get out of the stock market, but I'm going to shift some money out. 5% here, 5% there. And I think what they're doing is it's moving into those asset categories, safety of T-bonds and gold and silver. I think that's why those two markets are moving in sync right now. Don't expect it to continue. Because ultimately, yes, the T-bonds will go down in price, up in yields, because if inflation persists, which we think it will, then you will suffer if you're long the T-bonds. I frankly think we're topping right now. And I have been thinking that we're in a topping process for several months now. That doesn't mean it can't go up. I mean, you're up until you're down, right? Joe Randall said that. But we have numbers below the markets, both on the NASDAQ 100, which is our leader index. There's no question it's been the leader. It's outperformed everything. The top 5-6 stocks in the NASDAQ 100 constitute over 50% of its weighting. We all know those symbols: Amazon, Apple, Microsoft, Google, etc. They also constitute probably about 25% of the weighting of the S&P 500. So as these indexes have moved up, it's not because of all the symbols within the index. It's primarily because of the leadership has been so strong. And therefore, focus on the NASDAQ 100 because that's where the leadership is really weighted. We see numbers below the S&P and below the NASDAQ 100 that aren't that far down there. Now, considering that we've had a dozen-year uptrend, which is highly unusual, and a lot of that's been vertical, it's scary. And it's scary because if you're a price guy and you're looking at, let's say, a weekly or monthly price chart of the S&P or the NASDAQ 100, and you look at your screen, try to define where you think it breaks. Try to draw a trend line. It's almost impossible. Whereas you might draw one and then it goes up at a steeper angle. We have to draw it again at a steeper angle. It's like multiple lines. So there's no line that touches 3 points. It's just a curve. The problem for the price chart technician at this point in time is when you turn down, there's no consensus as to where, oops, it broke something. And when you don't have a sense of, where you are on the map, emotions can take over, panic can ensue. So it's going to be an interesting game this year. There's a lot of stuff's going to happen this year, not just the beginning of stuff, but actually the culmination of many of these turns. We try to put blinders on. I mentioned that I saw the front page of the Journal today, but I don't try to pay attention to what other people think or what other factors might be in play here. There are major factors in play, big fundamentals in play. We all know that. In our last weekend report, we had a Fed funds rate chart going back like 30 years. I mean, you just look at the silly thing and you say, no wonder the stock market's gone vertical for a dozen years. It's a zero, and for 10, 12 years, no wonder the stock market was inflated. We've had inflation for many years. Mm-hmm. It just didn't go into commodities until when asset managers again did what? Change their preferences from stocks to undervalued commodities that have less risk, probably more reward. And sure enough, that's what's happening. So now we have what the public and the Fed call inflation. In fact, we've had it all along. It's just been expressed elsewhere in a vertical stock market. So I think that bubble's going to burst. Not that the flow of money from the Fed or the ECB or the BOJ is going to stop. It's just going to go elsewhere because people aren't going to put it where the Fed would like them to put it. Now, what's the central bank going to do when the debt markets they must defend are breaking down? Are they going to taper? Are they going to raise rates? I think not. And I think gold knows this. Basically the central banks of the West are caught in a historical dilemma of their own creation. And they're going down the swirly along with their policies. And I think they're going down the swirly this year. Where will money want to go? It's been said cash is trash. Major asset fund manager said that some months ago, and he's dead right, and he's not even a gold bug. So I think the public is getting aware of this. And then we go to another interesting issue that's been debated on a lot of the financial channels lately. In fact, I saw something today on it. Bitcoin or gold? Well, we measure them both, but we've been watching the spread relationship between the cryptos, especially Bitcoin and gold and Bitcoin and silver. Because our bet's on silver. We think silver's going to vastly outperform gold. I think silver's going to leave gold behind on a percentage basis. But that spread is measurable, meaning the spread relationship of the valuation of Bitcoin versus silver. Well, clearly over the since Bitcoin's been around, it's a baby. It's only been around half dozen years or more. It's thrashing. People can't quite put a valuation on it, but it has definitely beat gold and silver in an irregular manner, but in an upside manner, very violent, just like its price has been. Those charts to us look vulnerable. In other words, it looks like we could be nearing a point where Bitcoin, on a valuation basis, relative basis, could top out versus gold and silver, and that they could replace it as the place where people are putting their money for safety reasons. And it wouldn't surprise us to the effect that, okay, the shift has occurred. It's time now to shift out of Bitcoin and into gold and or silver, preferably silver. Now, that doesn't mean Bitcoin's got to go down. It just means that Bitcoin will shift relative performance such that silver will beat it going forward. And I think that's about to happen. Ultimately, this time, I don't think there's a way out. And by that, I mean, you're not going to end with policy working or a Volcker comes in and ends it, and just puts the brakes on and stops the process. Of course, then you went down. We all know that once that happened. The stock market was a wasteland from about 1977 through 1982 at least. while gold and commodities outperformed it. But this time I think it's more, meaning I think at the end of this next crisis, and I think we're headed for one, not just in pricing, but in that, you're going to have people raise the question, it's been 50 years of this stuff since that Republican Nixon took us off the gold standard, international exchange basis of the dollar. And we've had nothing but fiat currencies in Europe, here, and Japan since then. It hasn't worked. And we think we've been under control, had a policy and all this nonsense. And it's just been a boom-bust cycle, getting worse and worse each time. And it wouldn't shock me, what a world this is to say this, that the ex-communist countries of the world have gold-backed currencies before we do and set the new trend. And I think that's likely to happen, where we end up with stable currencies. It could be crypto. Crypto at least can't be hyperinflated. It can be expanded somewhat year to year as they find more, et cetera. But it can't be, double the money supply every year like the central banks can do. So it's going to be an interesting year, and I think the markets are going to create what I call a swirly, and that swirly will affect not just markets, but people. It's hard to predict these things, but I think the trend is pretty evident, and we know that the wave effects will create all kinds of unusual outcomes that a lot of people can't, it's not on the tip of their tongue right now. Political events, social events, and so forth that perceived to be traumatic, but actually will be healing. Because if you get rid of something bad and it makes some noise while you're getting rid of it, that's the way it works sometimes.
Don't forget to hit that like button. It really helps out the channel. And if you want to stay updated with more content like this, be sure to subscribe and click the bell icon so you never miss a video.